Right. So picture this. It is sometime in the 14th century, somewhere in England, perhaps in a busy market town along a well-traveled road between two cathedral cities. And there is a building you would recognize immediately, even across 700 years of history. Low-ceilinged, smoky, smelling of wood smoke and ale, and animals and unwashed people in roughly equal measure. With rough-hewn tables and benches packed with travelers, merchants, pilgrims, laborers finishing a day's work, and the occasional wandering friar who has convinced himself that stopping for ale is a form of pastoral outreach. The person running this establishment, pouring the ale, managing the sleeping arrangements upstairs, haggling with the cook over the price of the evening's pottage, and quietly calculating whether this week's takings will cover what is owed to the landlord and the local tax collector, is doing something that looks, from a distance of 7 centuries, almost romantically simple. That impression that running a medieval tavern was a straightforward, uncomplicated business of pouring drinks and taking money is almost entirely wrong, and understanding exactly why it is wrong. Understanding the real mechanical economics of what was actually one of the most tightly regulated, most financially precarious, and most structurally complex small businesses operating anywhere in medieval England is the key to understanding an institution that shaped not just how medieval people ate and drank, but how they moved, how they traded, how they received news, and how their communities actually functioned at the most basic, day-to-day level. If this kind of breakdown, pulling apart the real economics behind historical institutions that shaped the world you live in today in ways you have never quite seen clearly, is the kind of content that genuinely interests you, subscribe to Money Framework British right now and turn on notifications, because this channel is built around exactly this, showing you how ownership, capital, and revenue really work. Whether we are talking about a modern British business you walk past every day or a medieval institution that was doing something surprisingly recognizable 7 centuries before you were born, let us start with the terminology itself. Because the medieval period used a set of distinctions between drinking and lodging establishments that modern English has almost entirely collapsed into a single, undifferentiated idea of a pub or a tavern. And those distinctions actually matter enormously for understanding the economics. In medieval England, there were, broadly speaking, 3 distinct types of establishment providing food, drink, and lodging to travelers and local residents. The alehouse was the most basic and most numerous, typically a private dwelling where the occupant, very often a woman, an alewife, brewed ale and sold it from her own home, operating what was essentially a cottage industry, selling a single product to local customers, with minimal infrastructure and minimal overhead, but also minimal capacity and genuinely uncertain quality. The tavern was a step above this. A dedicated commercial premises selling wine, the higher status drink of the medieval period, and often ale as well, typically located in a town rather than a village, serving a somewhat wealthier clientele, including merchants and traveling professionals, and frequently providing food alongside the drink. The inn was the most complex and most capital-intensive of the 3, providing not simply food and drink, but actual overnight accommodation with stabling for horses, making it an essential piece of infrastructure for anyone traveling the roads of medieval England on business of any kind. Understanding which of these 3 you are actually looking at determines almost everything about the economics you are examining. But for the purposes of this breakdown, we will focus primarily on the tavern and the inn, the 2 formats that most directly parallel what a modern audience imagines when they picture a medieval drinking and hospitality establishment, and the 2 formats where the economics are genuinely most interesting and most revealing. Now let us talk about the product itself, ale specifically, because it is the foundation on which almost everything else in this economics rests. and because it is considerably more complicated than simply brewing some grain and selling it warm in a pot. Medieval ale was not the same product as modern beer. It contained no hops, which were not adopted into English brewing until the 15th century when Dutch and Flemish immigrants brought the practice with them. Meaning medieval ale was made purely from water, malted grain, and yeast, with various herbs and spices sometimes added for flavor and preservative effect in a mixture known as gruit. This hop-free ale had a very short shelf life by modern standards, typically going sour and unpleasant within a few days of brewing, which meant that the medieval tavern keeper was not managing a product with a long, stable, predictable shelf life, but rather a perishable commodity and that needed to be sold quickly once brewed or written off entirely as a loss. This short shelf life created a genuine, constant tension at the heart of the brewing and selling operation. Brew too much, and the unsold surplus goes sour before it can be sold, generating a real cash loss on the grain and fuel already invested in its production. Brew too little and you run dry before the next batch is ready, turning away paying customers and losing revenue you can never recover. Getting this production and sales balance right, consistently, without refrigeration, without reliable demand forecasting, and without the kind of supply chain visibility a modern business takes entirely for granted, was a genuine, daily operational challenge for every medieval ale seller. Now here is where the medieval regulatory environment enters this picture, with a force that would genuinely surprise most modern people who imagine the medieval economy as a largely unregulated, every person for themselves kind of arrangement. The ale trade in medieval England was among the most heavily and most consistently regulated commercial activities in the entire medieval economy, governed by a piece of legislation called the Assize of Ale, which dated in various forms from at least the 13th century, and which set out with genuine, enforceable specificity the price at which ale must be sold relative to the current price of grain, the measures in which it must be sold, and the quality standards it must meet. Local authorities, typically through an official called the ale taster or ale conner, were empowered to inspect and taste ale sold commercially, to seize and destroy ale found to be of insufficient quality, and to fine the brewer or seller for violations of the assize's terms. These fines were not merely theoretical. They were regularly imposed and carefully recorded in court rolls that survive to this day, and that show a picture of constant, ongoing regulatory enforcement touching virtually every commercial ale seller in medieval England. What is genuinely remarkable about these records, and what tells us something important about the economics, is that many ale sellers appear in these records paying small fines repeatedly and essentially routinely, suggesting that in many cases, the fine for brewing below standard or selling at an unauthorized price had been effectively incorporated into the cost of doing business, functioning more like a licensing fee than a genuine deterrent, a dynamic that students of modern regulatory economics will recognize immediately as regulatory capture operating in a medieval context. Now let us talk about the capital requirements of actually setting up and operating a medieval inn, the most complex and most capital-intensive format of the three, because this is where the economics become most genuinely interesting and most directly comparable to the capital barriers this channel has examined in modern contexts. A functioning medieval inn required, at minimum, a building with sufficient room to provide both a ground floor drinking and eating space, and an upper floor sleeping area capable of accommodating multiple travelers simultaneously, typically in shared rooms or even shared beds. A reality of medieval hospitality that the modern mind finds uncomfortable, but that was entirely standard and entirely expected by travelers of the period. Beyond the sleeping accommodation, a proper inn required stabling capable of housing the horses of traveling guests. Because a traveler's horse was not simply a mode of transport, but a genuinely valuable piece of capital equipment that needed feeding, watering, and sheltering overnight, in conditions that would not leave the animal too exhausted or too sickened to continue the journey the following morning. The innkeeper who could not provide adequate stabling was an innkeeper who could not serve the commercial travelers and merchants who represented the most reliably lucrative segment of the medieval traveling market. Because those travelers would simply continue to the next inn along the road that could meet their animals' needs. On top of the building and stabling infrastructure sat the cooking and brewing equipment, the bedding and furnishings, the tableware, and whatever food and drink stocks were held on the premises at any given time, all of which represented genuine, meaningful capital that had to be acquired, maintained, and periodically replaced. The question of who actually owned this capital and who actually owned the building the inn operated from is genuinely important and genuinely illuminating about the medieval hospitality economics. Because the answer was frequently not the innkeeper. A considerable number of medieval inns, particularly in towns and along major roads, were owned not by the people actually running them day to day, but by local landlords, by religious institutions, including monasteries and cathedral chapters, or by urban guilds, with the actual operating innkeeper holding a lease on the premises and paying rent to the underlying owner in much the same structural way that a modern pub tenancy works. The tenant running the pub, paying rent to the brewery or pub company that actually owns the freehold. This separation between property ownership and business operation meant that the medieval innkeeper faced a structural position similar to what this channel has described in the modern petrol station breakdown, capturing the operating profit of the business while the underlying asset appreciation of the property accrued to someone else entirely, and being subject to the landlord's decision about lease renewal, rent levels, and the terms under which the premises could be used. Now, the food economics specifically, because they carry a particular structural feature worth examining directly. Medieval inns and taverns providing food were typically offering what amounted to a fixed daily meal rather than a menu of choices in the modern sense. A pottage or stew of whatever vegetables, grains, and occasionally meat were available and affordable that day, supplemented by bread, perhaps some cheese, and whatever the kitchen could assemble from local market purchases and whatever the establishment kept in its own small gardens or livestock pens. The gross margin on this food was genuinely uncertain and genuinely variable in a way that reflects a fundamental feature of medieval supply chains. The price and availability of basic food commodities fluctuated considerably with the harvest, and a bad harvest year, which occurred with uncomfortable regularity in medieval England, could dramatically increase the innkeeper's food costs precisely when hungry. Financially stressed travelers were least able or willing to pay more for their meal. This harvest-linked cost volatility was not something the medieval innkeeper could hedge against through futures contracts or supply chain diversification. They simply absorbed it as best they could, raising prices when they dared and cutting portion sizes when they had no other choice. A form of margin management that every medieval traveler would have been entirely familiar with, even if they lacked the vocabulary to describe it in those terms. There is also a structural feature of the medieval inn's revenue model worth naming directly, one that connects to a broader pattern this channel has identified across multiple modern hospitality breakdowns. And it is the problem of trust and payment in a world without credit cards, without identification documents, without any of the modern infrastructure that makes it relatively straightforward for a modern hotelier to ensure that a guest who has consumed food, drink, and a night's accommodation actually pays for it before leaving. Medieval innkeepers extended credit routinely and of necessity, because many of their customers were merchants and travelers carrying physical coin that they were understandably reluctant to display or spend unnecessarily in an era when robbery on the road was a genuine, common hazard. And because the social conventions of hospitality in the medieval period created genuine awkwardness around demanding immediate cash payment for every transaction. The result was a business that frequently had meaningful outstanding credit owed by guests who had departed and might never return, some of whom had left without settling their bills entirely deliberately, a problem the medieval English legal system addressed only imperfectly and at considerable time and cost to the innkeeper pursuing recovery. Bad debt was a genuine, structural feature of medieval hospitality economics. Not an edge case, but a routine operating reality that every innkeeper of any scale had to factor into their financial calculations. Now let us talk about the labor economics, because they carry a particular complexity that the modern image of a medieval tavern, typically populated by a single, cheerful alewife or innkeeper, managing everything personally, almost entirely obscures. A functioning medieval inn of any reasonable size required genuine, ongoing labor beyond what a single person or even a single household could provide. Brewing ale was physically demanding work, requiring multiple people. The malting, mashing, boiling, and cooling process taking the better part of a day and requiring genuine physical strength throughout. The cooking operation, maintaining a fire for hours and preparing food for potentially dozens of guests simultaneously, similarly required dedicated labor. The stabling operation, feeding, watering, and managing the horses of guests, required someone with the relevant knowledge and the time to do it properly. And the cleaning, laundry, and maintenance of the sleeping accommodation required ongoing, daily labor that did not diminish simply because business was slow. Some of this labor was provided by family members, some by servants who might be paid a combination of board, lodging, and small wages, and some in larger establishments by hired day laborers engaged for specific tasks. The total labor cost of running a proper medieval inn was genuine and meaningful relative to the revenue the establishment could generate. And managing that labor cost in a period when labor markets were periodically disrupted by plague, by harvest failure driving rural workers into towns, and by the legal restrictions of the manorial system that technically bound many agricultural laborers to the land they worked, was a genuinely complex management challenge. If the way that labor costs, property ownership structures, and regulatory environments combine to determine whether a business actually makes money is something you want to understand more deeply across British history and modern industry alike, that is exactly what Money Framework British is built to explore. Subscribe now and turn on notifications so you catch every single breakdown on this channel. Now, the taxation and civic obligation dimension of medieval innkeeping, because it represents a layer of cost and constraint that the romantic image of the medieval tavern almost entirely fails to capture. Medieval innkeepers in English towns were subject not simply to the assize of ale and the associated fines for quality or pricing violations. They were also subject to local taxation through the borough's own assessment processes, to the obligation to provide hospitality to certain royal and noble officials traveling on the king's business at regulated prices that left little or no margin, and in some cases, to the requirement to report to local authorities the identity and business of notable travelers passing through their establishment, a form of what we might today call mandatory information sharing with the state that created both an administrative burden and a potential source of conflict with guests who valued their privacy and their anonymity. The innkeeper sitting at what appeared to be the center of a simple commercial transaction was actually sitting at the intersection of local regulatory authority, royal prerogative, civic obligation, and private commercial interest, all simultaneously, and navigating that intersection required a degree of political and social sophistication that the romance of the medieval tavern entirely obscures. There is a genuinely fascinating dimension to the medieval inn's role in information economics that is worth examining directly, because it helps explain why these establishments were so economically important to medieval society, well beyond the simple provision of food, drink, and shelter. In a world without newspapers, without postal services accessible to ordinary commercial actors, and without any of the modern telecommunications infrastructure that makes information flow essentially instantaneous and essentially free, the inn was one of the primary mechanisms through which commercial information actually moved around medieval England. Merchants gathering in a town's principal inn shared news of prices in distant markets, of road conditions and bridge states, of political developments affecting trade, of the creditworthiness of other merchants, and of opportunities and risks in markets they had not themselves recently visited. This information exchange had genuine, measurable economic value to the merchants participating in it, and it gave the innkeeper who hosted it access to a flow of commercial intelligence that was itself potentially valuable, informing decisions about where to source supplies, what travelers to extend credit to, and how to price the hospitality they were providing at any given moment. The medieval inn was not simply a place to sleep and eat. It was, in a very real sense, a market for information in a world where reliable information was genuinely scarce and genuinely valuable. And understanding this dimension helps explain why successful innkeepers in medieval England could accumulate genuine, substantial wealth that went well beyond what the simple margins on ale and pottage would ever have been sufficient to generate. Now, the seasonal economics, because they are genuinely important and genuinely distinctive in a medieval context. The volume of traffic on medieval English roads, and therefore the volume of custom at inns and taverns along those roads, was not constant across the year. It peaked in summer and early autumn, when road conditions were best, when agricultural work had paused enough to allow some freedom of movement, and when the pilgrimage season was in full swing. The roads to Canterbury, to Walsingham, and to other major shrines, generating a substantial and relatively predictable flow of travelers who needed food, drink, and shelter along the way. It fell sharply in winter, when road conditions could make travel genuinely dangerous or physically impossible, when commercial activity contracted, and when the pilgrimage traffic all but ceased. This seasonal pattern meant that the medieval innkeeper was essentially running a business that generated the majority of its annual revenue in a compressed peak season, while still carrying the costs of maintaining the building, the stabling, and a minimum staff complement through the quieter winter months. A cash flow challenge that required either careful accumulation of surplus during the peak season or access to credit to bridge the winter gap. And in a world where formal credit mechanisms were limited and expensive, getting this seasonal cash management wrong could mean genuine financial crisis arriving precisely when the roads thawed and the traveling season began again. Now let us put all of this together, because this is where the real picture emerges with full clarity across the 7 centuries separating this business from the modern ones this channel more typically examines. A medieval English tavern, or inn, was a business operating under a sophisticated, genuinely enforced regulatory framework governing its core product's quality and price, carrying meaningful fixed costs in building, stabling, equipment, and labor that ran regardless of the highly seasonal and entirely unpredictable flow of customers through its door, dependent on extending credit in a world without reliable mechanisms for enforcing repayment, subject to taxation, civic obligation, and information sharing requirements imposed by both royal and local authority. and required to manage genuinely volatile input costs driven by harvest quality fluctuations that no individual operator could forecast or influence. It was a business where the successful operators were not simply friendly, welcoming people who happened to be good at brewing ale. They were sophisticated managers of labor, credit, inventory, regulatory relationships, and seasonal cash flow, operating at the intersection of commercial hospitality, civic function, and information network, in a way that made the successful medieval innkeeper a genuinely important, genuinely economically complex figure in the communities they served. So the next time you walk into an old British pub and admire the low beams and the ancient fireplace, and feel the comfortable weight of centuries of history settling around you, remember what you now understand about what those centuries actually looked like from the inside of that business. The person who built and ran the establishment that stood on that site 700 years ago was not simply pouring ale and counting coins. They were managing perishable inventory with a shelf life measured in days, navigating a regulatory system with genuine teeth, extending credit they might never recover, bridging a seasonal revenue gap with limited access to formal finance, managing a labor force in a world without employment contracts, and providing a service that was simultaneously commercial hospitality, civic infrastructure, and information exchange, all at once, in a smoky room that smelled of ale and wood smoke, with a tax collector due at the end of the month and a fresh batch of ale going sour in the back. If this is the kind of breakdown that changes how you see the world around you and the history underneath it, you are in exactly the right place. Subscribe to Money Framework British right now, turn on notifications, and make sure you never miss the next deep dive into how British institutions, British businesses, and British history really work when you look at the economics underneath everything else. Every breakdown on this channel is built to show you what the numbers actually say. When you strip away what everyone assumes, look at what was genuinely happening behind the